Welcome back to the Good Life Club, where we unravel the secrets of intelligent investing and help you pave the way to financial success. Today, we've got something special in store for you, the ultimate guide to building a bulletproof portfolio for 2023. Stick around because you won't want to miss out on this expert advice. Plus, we've got some valuable insights into the ever-changing landscape of the financial world, including the rising interest rates, monetary policy adjustments, and the looming specter of a possible recession. In the world of investing, timing can be everything, but it's not about attempting to predict market highs and lows. In early 2020, the S&P 500 index reached its local high on February 19th. Just over a month later, the market dropped 34% from that high as the market reacted strongly to the onset of the pandemic. Had you bought at the absolute bottom, your gains would have been well over 65% by the end of 2020. This prompted many investors to ask themselves, can you make money by timing the bottom of the market? While the allure of timing the market may seem enticing, it's essential to recognize that most experts and studies advise against it. Let's delve into the data. In a comprehensive study conducted in 2019, spanning from January 1st, 2009 to December 31st, 2018, the results were eye-opening. Hypothetically, if you invested $10,000 into the S&P 500 and left the money invested for the entire decade, your initial investment would have grown to $27,750. That's a 2.7 times return on your investment, an impressive figure by any measure. However, the real eye-opener comes when you consider the impact of missing just a few of the best days in the market. If you missed the 10 best trading days during that 10-year period, your investment would have grown to only $17,220. That means missing out on just 10 days could cost you over $1,000. The numbers become even more alarming when you extend the scenario to missing 30 of the best days. Your investment would plummet to a mere $918, resulting in a loss. The lesson here is clear. Staying invested for the long term and being in the market on those best days is crucial for maximizing your returns. Market volatility will always be part of the financial landscape, but selling off all your investments in response is rarely the best strategy. With this in mind, let's dive into how to construct a robust portfolio for 2023. The portfolio framework I'm about to share is tailored to those between the ages of 18 and 40 with a steady income. If you're older or nearing retirement, you may need to adjust your portfolio to align with your risk tolerance and financial goals. To kick things off, let's talk about cash. In 2023, cash is king. I'm personally looking to start the year with at least 30% of my portfolio in cash, a significant increase from the 10% allocation I had the previous year. The reason for this shift is clear. There's considerable uncertainty in the market, primarily due to the Federal Reserve's plan to raise interest rates in the first half of 2023. Tighter monetary policy means that money will be less abundant. Having cash on hand allows you to pounce on opportunities when they arise. I'm planning to hold on to this cash until the Fed signals a pause or halt in interest rate hikes. Remember, I don't possess a crystal ball, and the ideal cash allocation may vary based on individual circumstances and risk tolerance. The cardinal rule remains: time in the market is generally more rewarding than attempting to time the market. Now let's explore the heart of the portfolio: exchange-traded funds, or ETFs. ETFs are the bedrock of my investment strategy. They provide broad exposure to the market and offer a historically consistent annual return ranging from 7% to 10%. Investing in ETFs is like planting the seeds of your financial future. A fundamental principle of diversification is not putting all your eggs in one basket. In the context of investing, this means spreading your investments across different asset classes, industries, and securities. Diversification is your shield against unexpected financial turbulence. Smart, disciplined, and regular investment from an early age is the best way to allow your money to mature. The key to intelligent investing is diversification. A diversified portfolio minimizes risks while investing for the long term. It allows for a certain amount of high-return investments by offsetting possible risks through more stable alternatives. When you start early, you can also learn the value of disciplined saving and plan for your life goals. You can start with a mix of cash, stocks, bonds, or government securities. Once you develop confidence in your decisions and have sufficient capital, you can further diversify into areas like global markets and real estate. Here are the ways in which you can diversify your investments. Learn why diversification is a must. A diversified portfolio helps your overall investments to absorb the shocks of any financial disruption, providing the best balance for your saving plan. But diversification is not limited to just the type of investment or classes of securities. It also extends within each class of security. Invest in different industries, interest plans, and tenures. For instance, do not put all your investments in the pharmaceutical sector, even if it is among the best performing sectors amid the COVID-19 pandemic. Diversify in other sectors that are picking up, such as education technology or information technology. Asset allocation is key. There are two basic types of investment: stocks and bonds. While stocks are seen as high risk with high returns, bonds are usually more stable with lower returns. To minimize your risk exposure, you should divide your money between these two options. The trick lies in balancing the two and finding equilibrium between risk and surety. If you share a high proportion of the family expenses, you should be more cautious about your investments. It would limit the amount of capital you have at your disposal, and therefore, you may want to play safe with a higher tilt towards bonds. Assess the qualitative risks of the stock before investing. You can minimize the unpredictability of stock transactions by applying qualitative risk analysis before buying or selling a stock. A qualitative risk analysis assigns a predefined rating to score a project's success. To apply the same principle, you have to evaluate the stock through specific parameters that indicate its stability or the potential to do well. These parameters will include a robust business model, integrity of senior management, corporate governance, brand value, compliance with regulations, effective risk management practices, and the dependability of its product or services, coupled with its competitive advantage. In closing, let's reflect on the journey you're embarking on as an intelligent investor. It's a path that requires patience, discipline, and continuous learning. The strategies we've discussed today, from the importance of staying invested to the power of diversification, form the cornerstones of a successful financial future. As you navigate the ups and downs of the financial markets in 2023 and beyond, remember that setbacks are a natural part of the process. It's not about avoiding losses entirely, but managing risks and minimizing their impact on your long-term goals. Each decision you make, whether it's allocating assets or assessing the qualitative risks for a stock, contributes to your financial education. Furthermore, your financial journey isn't limited to just investing. It encompasses setting and achieving life goals, understanding global markets, and even considering life insurance as a way to protect your loved ones. These elements all play a role in your holistic approach to financial well-being. So as you move forward, embrace the wisdom you gain from both your successes and your setbacks. Stay aware of your financial biases and make decisions based on your unique circumstances and goals. Remember, you're not alone on this journey. Financial advisors and experts are valuable resources to guide you along the way. Thank you for being part of the Good Life Club. Until next time, keep making those wise financial decisions and make your path to a prosperous future be filled with success and fulfillment. In the coming months and years, we'll continue to provide you with the latest insights, expert advice, and strategies to help you live your best life.